Scott Valentin is a senior financial analyst at FBR Capital Markets. He follows some of these small banks like the ones that the president is meeting this morning. And Scott, great to have you with us. Okay, so
thanks for having me on the program.
Well, I know that certainly the same message is going to be given to these banks, which is you've got to lend more, and the message back, I presume, from them is, well, we'll lend more when there's more demand, and also when there's better candidates to lend to. So who's right in all of this? What's going to come out of this?
You raise a very good point. There's two sides of the story. One is the small business, which of course is hungry for credit. They're having a hard time getting credit right now, although I think that's a little bit overplayed in the media. If you look at some of the surveys out there, small businesses that are in good shape are finding access to credit. We're in a recession. More small businesses are struggling, and banks are tightening credit, which they always do in a recession. So it does make credit harder to get. That's a natural function of what banks do. Mm-hmm. The other side of the table is the banks themselves. They're facing a lot of uncertainty as well. The regulators are becoming a little bit more strict in terms of coming in and classifying credits, requiring more reserves, requiring which hurts earnings and capital levels. Also, the banks themselves, looking out and saying, okay, what's going to happen with capital levels? Do we have to hold more capital in the long term? So a lot of uncertainty with regard to the banks. It probably makes them a little more cautious than usual.
Now, who's not lending as much, if you can make that comparison between the big banks and the small banks?
Well, the issue with the small banks is they vary greatly, right? You have, usually among small banks, much more geographic concentration, usually a higher level of commercial real estate, which we believe, commercial real estate was still in the very early cycle of losses. So a lot of banks that do have high commercial real estate exposure are trying to retain capital, knowing that the pain still lies ahead. So it's hard to generalize across the board who's lending, who's not, particularly again in the small bank situation where you have a huge variability in just the condition and the makeup of the banks themselves. But I do think the small banks, you'll find pockets of small banks where they are making loans. They have capital, they feel comfortable, their economies are holding up relatively well, and they are making loans. It really varies greatly by geography.
But Scott, can you give a sense, though, of, for instance, the percentage of loan applications they get, what gets rejected, and compare that to, say, a few years ago?
I would say today I would argue, I don't know the exact numbers, but I would argue today probably the rejection rate's much higher for small business applications, just because, again, in a downturn, banks by default tighten underwriting standards. And you couple that with the fact that most of the borrowers are undergoing some form of stress, so cash flows are lower. Generally, the financial condition of the small business is not as strong. So you have these two kind of negative trends colliding together to force a lot less credit being put in the system.
Now, I would imagine, though, that a concern for the White House should be that if they force these banks to lend too much, they're going to go bankrupt, because we've seen a number of small banks just go under.
So far, most of the drivers of the bank failures have been commercial real estate exposure, specifically construction and development lending in the hottest markets, where those markets, the values really plummeted. C&I really hasn't driven banks yet out of business. The C&I cycle, commercial industrial lending, the small business lending, so far hasn't caused the pain. That's probably still, probably not all the way through that process yet. But I do expect C&I to perform better than commercial real estate in general. So it is a concern for banks going forward, though.
Okay, so at the end of this cycle, though, Scott, what is your view on are we going to see a third less banks, small banks in the United States? Or, at the end of this bottom line, what are we going to see?
Well, I don't think it's a third less. There's over 8,000 banks right now. Obviously, the big 4 or 5 control most of the assets. But as you get a kind of a barbell structure in the industry, that creates a lot of opportunity for small banks, because, again, small businesses tend to be more service-oriented. They're willing to pay up a little bit more for a loan if they can get the right person on the phone. And you're seeing also with consolidation, bank management teams who ran small banks, they get bought by large banks. They do 2-3-year non-competes, and they start a new bank with the same team. So there'll still be plenty of small banks out there.
Okay, Scott, good to talk with you. Thanks so much, Scott Valentin of FBR Capital Markets.